Welcome to the Hotel Business Lender Brunch. My name is Bruce Ford. Thank you for the invitation, Jay. Thank you, Alan. Thank you, Hotel Business. Thank you, Best Western, for the opportunity to be with you here today. Today in the hotel business, we've had, obviously you're all aware, 6 to 7 incredible years of operating performance growth. Off a downturn in 2008, we've seen in 2015 record profitability in the hotel business, and that has really accelerated investment, into new construction. Last year, at the beginning of last year, we had 150 developers of 3 or more new construction projects active in the pipeline. Today, as I mentioned a little bit earlier, it's up to 249. They're building these mid-scale, upper mid-scale, and upscale hotels, very popular prototype designs that in fact can be built cheaper today than you can go buy one. And much of the reason for that is a direct result of operating performance continuing to be very good. Now, is it going to grow at the rate that it did between 2013 and 2014? No. Is it going to grow at the rate that it did between 2015 and this year? No. The next couple of years are what we call a soft landing zone without an external economic impact. The maturity of the lodging industry is upon us. We have some growth remaining in the new construction cycle. We have a stuck transaction market at the moment. I would call the transaction market today recycling. Shall we say? We were at a hotel industry conference last week in Phoenix, Arizona, and I think the general sentiment was there's more properties coming to market. And those properties that are coming to market are a good mix of these select service brands. They're also a good mix of existing hotels that maybe need a little bit of renovation, but also existing construction projects that may not quite be open as of yet. So we expect a couple more years of new project announcements. We expect a couple more years of transaction activity. We expect earnings to begin to peak out. The growth can't continue at the rate that it has. So we're expecting a kind of a topping off of the industry to occur in 2018. And at the moment, our best estimation is for that cycle peak to be a soft landing. At this point, that's our forecast. So what will the pipeline look like when that happens? Much of what we're doing in the new construction pipeline today is driven by those select service chain scales, the upper mid-scale and upscale. Today, we're putting together a pipeline in the dark gray of the under construction number of rooms, and start in the next 12 months, the lighter gray, and in early planning, the darker red. You can see that the early planning numbers are declining a little bit, whereas the under construction and the schedule to start in the next 12 months continues to take a larger portion of the pipeline. That is cycle unique, in that the time that we're in the cycle, we don't have many projects that are planning for 2020 or planning for 2021. Many of those projects that are in the pipeline today that are beginning construction have been in the pipeline for less than 2 years. So we've seen a little bit more of an accelerated timeline for projects that enter the pipeline and then in turn exit the pipeline much faster today. The expectation for where we may be in pipeline size at the end of 2016 and the end of 2017 may be just under 600,000 rooms at the end of this year, and by the end of next year about 650,000 guest rooms. Where does that compare historically? You can see the last peak, 785,000 rooms in the center of 2008, right before we had an external economic impact to the hotel industry, the last one. Where will we go? Will this accelerate a lot more? Not expected to. Will we reach 785,000? We probably will, sometime in 2018. The expectation is that the industry will build more hotels over the top of the operating performance peak. That's the way it usually goes. And putting together the pipeline by project stage, putting some numbers to the graphical detail that we looked at a little bit earlier, you can see 2Q 2015 compared with 2Q 2016 and the percentage change. We talked a little bit about how much starting the next 12 months and under construction is growing. It is clear and evident on this page. So nearly a 40,000 room growth in under construction year over year, and nearly a 60,000 room growth, 51,000 rooms in starting the next 12 months. And starting the next 12 months means exactly that. Each one of these numbers would represent an actual hotel in our database that's scheduled to go under construction in the next 12 months, with a date sometime between July 1st, 2016 and June 30, 2017. Most of the upper mid-scale and upscale projects enter the pipeline in that chain scale. Many cases when you sign to develop a Hampton Inn or a Fairfield Inn or a Holiday Inn Express, you're signing to begin that hotel construction within the next 12 months. This early planning decline is a signal, I think, two things. Number one, we're not building a lot of large hotels today, okay? As a matter of fact, there are less than 100 projects that are greater than 300 rooms in the new construction pipeline, which historically, again, is unique. We would typically have a lot more larger hotels. But we continue to see more brands announced in the select service chain scales of upper mid-scale and upscale, and those truly are the new construction brands. Much of the market for luxury and upper upscale continues to see more renovation and conversion activity. The creation of many of these soft brands has led to more hotels changing brands, okay? The new construction by chain scale. So we're looking at the industry standard, we're matching up with the industry standard here for luxury, for upper upscale, for upscale. You can see that if you added these two columns up, a significant percentage of the overall new construction pipeline aligns with two chain scales, upscale and upper mid-scale. For those not familiar with what upscale and upper mid-scale are the brands of Hilton Garden Inn, Courtyard, Homewood Suites, Residence Inns, okay, the Best Western Premier brand, as well as upper mid-scale being the Hampton Inn, the Holiday Inn Express, the Fairfield Inn. These are the popular brands with developers. In many cases, they can build these for cheaper than you can buy them today. The unbranded line down here at 106,000, if you were looking at this last year, that was 50,000 rooms greater. We truly have seen a shift away from maybe opening independents that we've seen moving up the cycle and going more towards branded assets going forward. I'm going to take that 106,000 guest rooms in the new construction pipeline that were unbranded, and now I'm going to shuffle them into the chain scales. Lodging Econometrics tracks a like type chain scale for every project that we put into the pipeline. So our like type chain scales tell us that the percentage of upscale and upper mid-scale will continue to grow. The unbranded hotels often are coming out as very nice 3.5 to 4-star independent hotels in urban centers. Our forecast for the new construction pipeline going forward in 2016, 17, and 18, we will have the first year of 2% supply growth this year in this particular cycle. Next year, an estimated 2.3 and then 2.7 in 2018. These, again, actual new construction projects in our database. So this is a total number of rooms that are scheduled to open. The 2018 forecast is fresh this summer. 145,000 new construction rooms in the United States is about 10,000 below the last cyclical peak. So the estimation is that we are opening more hotels, but they are smaller in this cycle, okay? Responsible owners are looking at projects that are more like 110 rooms to 130 rooms, and less on the larger 250 and greater. How does the pipeline break down by chain scale for those scheduled openings? Okay, this is indicative of where we are in the pipeline. Luxury is actually on the decline for new construction opens. Okay, whereas upscale and upper mid-scale going from upscale from 33,000 to 40,000 to 47,000. Upper mid-scale 40 to 50 to 61. Okay. You can see the aggressive growth in these chain scales. They're permeating urban centers. They're going up at airports. They're getting connected to convention centers. It is the new popular, some people would say this is where the millennial brands are in fact going. And we have seen a nice rise in mid-scale as well, as both Hilton and Marriott now having mid-scale growth brands. What are the markets that we are looking at throughout the United States? We're here in New York today. New York still has the largest new construction pipeline of any market in the United States, and it holds that title globally. New York last year had 33,875 rooms in the new construction pipeline. As of right now, 32,121. We continue to open hotels. Supply growth in New York is scheduled to be above 5% for the next 2 years. Average demand growth is about 2 to 2.3 historically, so New York has some new supply additions coming to the marketplace that could hinder some operating performance. Houston has also been well talked about. Houston's had about just under a 2,000 room growth in their new construction pipeline. Los Angeles, about 2,000 rooms. Miami, almost 3,000, 3,400. And Dallas continues to rise as well. These markets are in line with the industry standard, so a market area is an MSA that's been boiled down to just include where the hotels are, so the commercial districts. What would be the next 5 markets? Believe it or not, the top 5 markets do not have the top growth market for new construction in terms of projects and rooms. That would be Nashville, Tennessee. Number 6 has seen nearly 6,000 rooms added to the pipeline in the last 12 months. Aggressive growth in Nashville. We've also seen several of the markets grow. Washington, D.C., a bit on the decline. They had a number of openings in the past 12 months that have left the pipeline. These being the top 10 markets in the country, you can see Boston here, although only changed by 100 rooms, the project count has gone up significantly, as the projects that are entering the pipeline are in fact smaller than those that are coming out. What do the franchise companies look like? Again, these are numbers from July, okay? So the franchise companies, in terms of the growth of their new construction pipeline, okay, you can see Marriott, a very nice spike this year. Hilton, also a very nice spike this year in terms of projects in the new construction pipeline. Hilton, Marriott, and IHG continue to be dominant. Best Western would be right at number 6, okay? But we would tell you that Hilton, Marriott, and IHG, with the collection of brands, continue to dominate the chain scales. How does the pipeline look around the world? So this chart breaks down each one of the 4 major regions. So we have the United States, the remainder of the Americas, EMEA, Europe, Middle East, and Africa, and Asia Pacific. If you take the total pipeline down here on the bottom and you would add all of this up, you would see across the chain scales in 2Q 2016, we have nearly 1.93 million guest rooms in the new construction pipeline. And the U.S. only has 570,000 of that. What's significant here? The U.S. is the growth region, okay? We have definitely seen international investment dollars move from investing in their local regions or their germane regions moving towards the U.S. We've seen it both on acquisitions, and we've begun to see it on new construction as well. Comparatively, in the Asia Pacific region, 836,000 rooms in the new construction pipeline, compared with 569 in the United States. Some of the notable countries for pipeline outside of the U.S., China continues to have a pipeline that is very impressive, but at this time it's actually below the United States as we've risen above it recently. Indonesia continues to see a significant amount of investment. India is sliding down a little bit, down about 20% year over year in terms of projects. Little difficulty getting them through the pipeline. South Korea, a surprise to some, but 35,000 rooms in South Korea. Unbelievably, 28,000 of those are in Seoul. Top markets throughout Asia, Seoul, South Korea continuing to rise at 26,000 rooms, but most of the markets in China are now on the decline. Jakarta, Indonesia continues to have a very impressive pipeline. Lots of new brands in Asia, as addition to what we're seeing here in the United States. In Brazil, the pipeline got largely built. You can see some of the trundling down of that particular pipeline. Mexico continues to rise. We're seeing United States companies go down and invest in Mexico as the market continues to grow down there in a few of the major cities and capitals down there. Argentina, the number 5 in Latin America for project counts. Throughout Latin America, we see a few markets that continue to have pipeline. Rio de Janeiro, the large part of those hotels were built down there. Some of those projects are struggling to continue to get to construction, as we're seeing some more delays as a result of most of the global events being over in Brazil at this time. Where else throughout Europe are we seeing pipeline? The United Kingdom has continued to grow. 35,000 rooms in the pipeline in the UK today. We're tracking all of these projects just like we are in the United States. Germany with 146 projects. Russia pretty consistent around 20,000 rooms and has been for the past couple of years. Some of those markets of interest throughout Europe, Middle East, you can see that London, Moscow, Istanbul continue to be the top markets, not comparing its size to many of the markets in Asia. A quick look at transaction valuations in the United States, and I just want to jump back to this. I know several of the team, executive team in the room are looking consistently at transactions and wondering what may be happening. I have some news to report about hotels that have sold that are greater than 200 rooms. You can see that the value has begun to decline. The transactions we're able to track. What we are seeing that is transacting are hotels that need a mild renovation. So those valuations are unique to the real estate, and then there would be a certain value over that would include the renovations, probably to reach a valuation somewhere in the middle of the $259,000 per room that was calculated in 2015 based upon transactions we were able to obtain a selling price for. Much of what we're going to see going forward, we'll probably see this number continue to remain stable, okay, and continue to see this stabilizing at a number that's probably under $200,000 per room for transaction values of greater than 200 rooms. Much of what we see in the industry, we're looking through a looking glass that says it's going to depend on what happens in 35 days, okay? Much of the election change, okay, will lead to different economic impacts, okay? We are expecting to see the Federal Reserve raise rates at the end of this year. We are expecting to see, okay, hoteliers come back to the market with vigor and with cash to invest. They have had 6 good years of operating performance improvement. There are some people who are in the wait and see model at the moment. Tell me what's going to happen and then I'll tell you how I'm going to react, okay? And some of the lenders are looking for that rate rise to again begin to continue their effort to invest in the marketplace. Ladies and gentlemen, thank you very much for joining us today on this live presentation. Thank you again to Hotel Business for bringing us to the stage. You can certainly pick up a copy of this presentation by sending a tweet or joining our LinkedIn page, Lodging Econometrics. Thank you very much.